All right. We've got a new segment we're rolling out here. So this is a new thing we're going to start doing monthly, the retail recap. So me and Will are just going to sit here and make funny jokes if we can and listen to two experts talk about this field. But we've gotten to a lot of retail here lately with our fund structure, and that's where a lot of that money gets allocated towards. So we thought it'd be good to deepen the knowledge on it and put a structure together that kind of keeps us every month kind of staying on top of a couple themes that are going on in the industry. And so, but more importantly, I just wanted to do a podcast with Rob Franks, so that's how we're here.
It's our second iteration, man.
Yeah.
We've done this once.
So, but in addition to Rob joining us, we got Bob Moorhead as well. So, but Rob, I'll let you just kind of start off. Everybody knows who Will and I are at this point, if you're listening to this, most likely. So,
yeah, I love it. Well, first of all, thanks for having us. Really enjoy being here. So, Rob Franks, I've been in retail for almost 25 years now. Started with a small company called Rhino Video Games. Eventually, we sold to Blockbuster. Was at Blockbuster for a while. That's what moved us out to Dallas, and then made a move to FedEx Office, and then eventually to JLL 18 years ago. So time flies. Actually, that's when I met Bob, was our days at Blockbuster together, back when people still rented videos and video games.
Seems like forever ago.
That does seem like forever ago. But, Jeremy approached me with the subject of putting together a retail podcast. And, honestly, we do, my focus is on retail tenant rep. We've got a great fleet of clients that we represent in and around Dallas, east and west, and up into Oklahoma as well. And probably my biggest gap in knowledge, I would say, is, kind of the capital markets piece of it and cap rates and everything that goes in that. And so as Jeremy and I were talking, I thought, man, we've got to bring in somebody that's what they do day in and day out. And Bob was the first guy that popped into my head. So I called him, and, by coincidence, he answers the phone. I tell him what I'm thinking, and he's like, man, you wouldn't believe this, but, a week ago, I'm sitting around with our other principals, and we're thinking, hey, we need to increase our visibility in the industry. He's like, this is perfect for that. So anyways, he stepped in right away. He was an immediate yes, and here we are. So glad to be here.
Yeah, awesome.
Absolutely. No, Bob Moorhead's current at lease. Happy to be here and excited about, talking with you guys once a month about retail and what's going on. And as Rob said, him and I worked together at Blockbuster years ago, been in the business 25 plus years at this point. Kind of on the corporate side, the first part of my career, Radio Shack before Blockbuster, and then Starbucks after Blockbuster. And left there in 2008, did a little bit of consulting, and then partnered up with a guy by the name of Joe Caputo, who had came out of just investment sales, pure investment sales, with Marcus and Milchap and some others. And him and I partnered up back in 2010, worked on a big project, and then kind of made it official in 2011 and focused on net lease investment sales since then. So it's been a good run. It's been a little challenging here the last 18, 24 months. And so that's part of, I think, what we're getting together and chat about each month, and what are we seeing, what trends are we seeing, and kind of what's happening in the market. So excited to be here with you guys and appreciate the invite.
Yeah, awesome. Yeah. Well, I think it's cool that we have you kind of have the bookends of what happens in a transaction. You got Rob looking for sites on the front end. Developers are trying to get tenants into their sites. And then the developers are most likely trying to sell that site at that point, and then that's the other end of it, and that's where Bob comes in. So this kind of covers the life cycle of what a retail property goes through. And our Will and I, we kind of stumbled into this stuff just from loaning money to people. We kind of started loaning money in some industrial deals, loaned some businesses working capital, attached to real estate, and then we kind of discovered this pref space where a lot of these single tenant net lease retail developers like to use as a source of capital. And we got to go to our first ICSC last year, which we call the most efficient real estate meeting ever had. But it was amazing. It was amazing watching that process. It's I'd say it's, you have the real estate the real estate directors on one side of the trade show floor. You got the brokers in the middle, and you got the the developers on the other end, and man, everybody's just, going back and forth right there, just kind of making it all happen. So it's very interesting compared to the industrial world where we're at a lot of the time, where we spend on the ground level at, where, tenants need one space in a market, and so, but a retailer's got to roll out however many, is in their plan. And
or shut them down,
which happens too, right?
That happens as well.
So, but for us, it was a very eye-opening experience at the scalability of that side of things for us. And so we've really come to, Kyle, we probably have 10 retail assets we're
correct
preferred equity in right now. Yep. And so we're real sensitive to, one, where is the site, and then two, what do those sites trade at? That kind of market. Is it a, tier one market? Is it a secondary market? Is it pretty tertiary market? And how does that affect cap rate? How does that affect exit? What's this developer building to? If it's Dallas, it can be a little less of a spread. But if it's
kind of like what we see on the industrial side, we've got objectives for Oklahoma City,
right,
and San Antonio, and they're probably 50 bips to 100 bips different than what we would do here in Dallas.
Yeah,
there's a little bit of a comfort factor too, just because of our network. We're like, 12, 14 foot cleared, not ideal in DFW, but we can work around it if we have some other attributes, or Jeremy's got a roster of tenants or whatever. But really, we got our first true DFW net lease development deal we're going to participate in.
Yeah.
Everything else has been out of market and or out of state. So for us, we've gotten calls Massachusetts, Ohio, Georgia, South Carolina, North Carolina. You're like, I got to figure this all out. But very sensitive to all that and just interested to learn more about
I think what you touched on as far as markets and all those things factor in, especially right now with kind of the craziness that's in the market, the uncertainty that's in the market as far as, where is it located? What's the quality of the real estate? What's the quality of the tenant? Are they growing? Are they shrinking? What's the price point? All those things factor in. A lot of what we hear today is immediately from buyers, whether they're West Coast or East Coast, is what do you have in Texas? What do you have in Florida? They see all the time on the news, those markets are growing, companies are relocating there. They just see all of the positive momentum that Texas and Florida have. And so a lot of times that's what we hear out of the gate from investors, whether they're in California, New York, or anywhere in between. And there's other good markets, but to your point earlier, Will, about Oklahoma is going to trade differently than Texas, especially major market in Dallas, Houston, Austin, San Antonio. So market is definitely a factor. Price point's definitely a factor. The tenant, what's their lease structure? That's a factor. Is it investment grade? Is it not?
Yeah.
All those things definitely play into it. And it can be a pretty wide swing as far as, is it corporate credit or franchise? All of that factors in big time.
Yeah.
Rob, what about site selection? Is there any way people look at things differently versus a tertiary or secondary or primary market, or is it?
Yeah, no, 100%. We've got the majority of our clients are focused on Dallas, DFW proper, right? And so, and honestly, the majority of those clients are really focused on that kind of that golden triangle, right? So 35 to 75 up the tollway, up to 380, and now it's gone north of that. But that's, the majority of our local transactions are performed really kind of right there. And then as we're market planning DFW, if we've got a new client coming in, we're identifying what are those top tier target opportunities, and then we go out and chase sites in those markets. So going into it, we've got a market plan saying, hey, we can grow Dallas to 20 new restaurant locations or whatever it may be. Well, what we see on the life cycle is after a tenant has filled out a market like DFW, they've probably done the same in Orlando and Miami and what have you. Well, that's when you have to start getting a little more creative and going to the tertiary markets, right? So, T-Mobile, for instance, who has thousands of stores, You can't open another store in DFW without cannibalizing an existing site, but we could go to Lindale, Texas, and open one and capture an entirely new market that we're not grabbing today. And I think that's where you see that shift is you go, all right, well, in Dallas, we only need 5% of the customers in our trade area to come for us to be successful. But if we're going to go to a smaller tertiary market, we need 30% of customers in that immediate trade area to come in. Well, typically they have less options, right? You may not have competitors out there or as many competitors. So if you're a restaurant, you only have 6 other restaurants that are of similar quality in a tertiary market when you have 60 in a DFW market that are all competing for the same dollars.
Yeah. What go?
That's just so interesting.
It's
because in the industrial world, let's just use equipment rental as a good example. That's like really the only tenant that I know of that is truly multi-location sometimes in a city. And they are so sensitive to cannibalizing the other location. Like we've got a site in Cedar Hill, and every major group that we've talked to is like, oh no, I'm in DeSoto or Duncanville or this area. And they're hypersensitive to that. And so it's just different to hear that from you because oftentimes, though, most guys in the industrial world, they only have 1 or 2 locations in a major city. Often it's 1.
Yeah.
They don't need 3 logistical distribution
well,
centers.
cannibalization is something we deal with every day. And that's, I touched on the market planning, right? It's amazing when you can come in with a clean slate and really kind of start placing your locations how you want them. You avoid that cannibalization conversation. Alternatively, if we've got an existing fleet of stores that we're working around, we'd have the best site in the world. But if you're going to pull 10% from this location and 12% from this one and what have you, if that modeling comes back with 35% cannibalization, you probably can't do the deal. So that's a big factor in what we do. And I mean, that's a huge growth engine in the real estate industry is the modeling and the forecasting that goes into those. So that's a big component of what we do. And, going back to our days at Blockbuster, we were one of the first companies to really pioneer that information. We had, as a customer of Blockbuster, we had your address, we had your phone number, we know how often you came, how much money you spent. And it was, for me as a young guy in the business, I thought every retailer had that information. I was like, oh, well, anywhere you go, we're going to have the same kind of research platform. And that wasn't the case. But that's a big factor in our decision-making today, for sure.
Now it's a lot of cell phone pings, right?
100%. Yeah, that's its own business.
On the retailers you're working with, what are they looking for as far as relocations? Are they looking for a 20% bump, 30% bump in order to make sense financially? Or
Sure. Relocations are one of the hardest things to get done in our business, right? And even if you have the best of intentions, when you really start doing the math and thinking about, hey, we're going to spend X amount on the build out, we're going to sign a new 10-year lease commitment. Like, are we sure we want to do this? And I could say, those are probably the fewest amount of deals that we do are true relos. And I think there has to be a cause for that. And that's typically what we see is like, hey, the center has deteriorated around me. This no longer has the brand image that I want as a company. I've got to move out. My sales have been declining year over year. I lost my anchor space, or I got an anchor I didn't want. I've got to move out of here and kind of start fresh and start over. And then, you want to see that incremental jump in sales, but then you also want to see a growth trajectory. Is that going to continue over the next 10 years? And I think that's where it really comes into play to make a reload make sense. But they're hard to get done. They're great in concept, but when it comes time to execute, and you realize it's the same amount of money to go get a net new location where that's brand new revenue coming in versus I'm going to spend that money to move it and hope that I get 10 or 20% increase in revenue from that reload.
When I was at Starbucks, that was something that we would look at. And to your point, it was always challenging because of the investment into 100%. The new site. And then you really got to justify it with an increase in sales volume where you're like, this makes sense long term. We can see, an uptick in sales over a period of time where there's going to be a good payback and the ROI makes sense. And with them, it was a little easier because what we were doing at that point was putting kind of non-drive-through sites that were maybe positioned okay, but going freestanding with a drive-through. Then all of a sudden you can show that bump of 30% or plus in the sales in order to really project an ROI that made sense. And so I think it's tougher on the retailers where you're not necessarily going to get that big bump just because it's the new prototype unless there's a drive-through attached to it. Maybe like Chipotle going to the Chipotle lane.
Right.
Or
Panera Bread.
That's right.
Doing the same thing.
Adding drive-throughs.
Yeah. One of the first drive-throughs in the company was in Frisco, Maine, in the tollway. And that store just absolutely blew the doors off, right? As you would expect, suburban America, mom with kids in the back leaving soccer, doesn't want to get out of the car to walk inside. That drive-through absolutely crushed it. Well, that changed the prototype. Now almost everything has to have a drive-through. And they're doing the same thing Starbucks looked at, pulling those cafes out and doing the standalone drive-throughs.
An interesting note, just kind of related to that, is on the investment sales side, there's been a couple instances where we've had a site that it was a Chipotle, but it wasn't the new prototype, didn't have the drive-through, didn't have the Chipotle lane, and buyers kind of gravitated away from that because that was something that they're looking for going forward.
Right.
We also had a Torchy's, and it didn't have a drive-through or pickup lane, and so I think buyers are becoming they're more aware of what's happening in the market and how important that drive-through or pickup lane is because it just generates more sales. And then they also think about in the future, if this concept goes away, it's much easier to re-tenant if it's got that drive-through already. It's already permitted. It's already in place. And so the smart investors are taking that into account. But it's interesting as we're talking about that. That's related.
Now, let me ask, would you price those differently? Let's say you had two identical Chipotles and one has the Chipotle lane, one doesn't. Do they come out at the same price?
Absolutely. Yeah, I wouldn't price it different, but
one's going to sit arguably longer than the other.
That's right. It's going to...
Will they trade differently?
It shouldn't, but, look, I would tell you, if they're in different markets, like a preferred market like Texas or Florida versus somewhere in the Midwest, that's going to trade different.
Sure.
Or Texas versus Oklahoma, but same concept, same market, Chipotle without the Chipotle lane shouldn't trade different, but there may be buyers that don't pursue it because it doesn't have it. It may take a little bit longer. Time to market may be a little longer, but should still trade relatively the same.
So I also want to touch back on, you talked about relocation.
Yeah.
And I think you fully explained why landlords don't pay renewals on tenant rep fees. They're like, you ain't moving, we ain't paying you. I negotiated one retail deal in my whole career, and I was like, all right, here's my commission agreement. They're like, we ain't paying on renewals. I was like, what? They're like, yeah, we don't pay on renewals. I was like, since when? Like, who doesn't pay on renewals?
We're the only sector that gets hosed on the renewal game.
I know. But you just gave the secret sauce away. They'll go, we ain't fucking moving.
I've always been in retail. So when I heard industrial guys get paid on renewals, I was like, man, we should have went industrial.
Yeah, but just remember the rents are like, like a third.
Well, depending on where you're at these days. But no. It's small spaces are high, but then it's just 2,000 feet. But and it's a big thing for brokers too. When they're taking on a new project in our business, they're like, you pay on renewals on the leasing side? Because some groups, they don't. They don't pay. Yeah. They just do it direct. Mm-hmm. So they'll cut them out.
Yeah. No, there's certain landlords like that.
We pay on renewals.
Is there a clawback most of the time? If they exit early?
No. And you get that. I've had that conversation before, and I say, hey, look, we'll just do due diligence on the front end. If you don't want to do it, then don't do it. Like, but, or if we agree to something at that point, like, hey, let's just get this done. Sure, I'll rebate you if it comes back. But that got me fired one time. He's like, hey, you need to pay back fees on people that don't leave. And these were like 2,000 foot spaces, like industrial tenants. I'm like, dog, we ain't ever landed a credit tenant in here. So, like, I'm on the hook for everything I'm fixing to do. I go, maybe just go find someone else.
Not worth it.
Yeah, we had a landlord that wanted to pay us monthly over the term of the lease. A 10-year lease, pay my commission every month. And I said, I don't even know how to invoice that. Like, that's a nightmare. Yeah. The answer is no. Like, just pay me at the end of the 10 years. Just pay me back.
He asked you for your Venmo.
That's right. I get a gift card every month for $25.
Well, something that's kind of interesting now that we've gotten into this retail space is like we actually go like eat places and think about it from that perspective.
Yes. Oh yeah.
And so last Friday we went to lunch and we went to, I don't even know how to say it. How do you say that place?
I think it's pronounced Qdoba.
Qdoba.
Okay.
Yeah.
So we usually go to Chipotle right here, right?
Okay.
So, but
we crush Chipotle.
Yeah.
We love it.
There's a Qdoba down the road. So I was like, hey, let's go do some
change it up
market research.
Yeah.
Like, I'll buy lunch. This is like a real thing, Yeah. We're working here. So we go to Qdoba, and I mean, the traffic compared to Chipotle was like
night and day. Yeah.
Now, I think there might have been some difference in quality of product.
Sure.
But like the location of it was a real issue.
Yeah.
It was in a strip center. Both are in a strip center.
It was a threeplex.
Chipotle's in a threeplex.
This one was in a strip center too.
Yeah. This one was in a full on strip center though.
Yeah.
And I don't know, it seems like it
was on the end cap.
It was on the end cap, but it's harder to get back onto Park Boulevard.
The street kind of bend. So like, I don't know. It was on the north side of Park, but the street bent. It did like a dogleg left there, and it was right on the corner. So like pulling in, it was easy, but getting out, nightmare. Yeah. I mean, it was just like you couldn't. The angle was kind of weird, and like the turnouts were kind of weird, and then you had to kind of get in the median. And at one point, Jeremy's like, "This is why people don't come in here."
Yeah.
Is that like the thing?
More than likely, it's a franchise.
It's a franchise.
And so that's probably the biggest difference. Chipotle's corporate for the most part.
Okay,
I'm not aware of any franchise agreements that they've got, but they may have some. But for the most part, they're corporate deals. Their criteria is stronger financially. Obviously, they're stronger. Yeah. They can take better sites, pay more money for the rent. Franchisees it really depends on the strength of the franchisee and what are they willing to do as far as invest in sites. And so I bet that was a franchisee location. And unfortunately, they're taking some inferior spaces from what we've seen.
Well, it's not only that, but then the product that you're receiving, right? So that may be a one-off franchisee. That may be their first ever location, right? And they've got the aunt is working the counter and the dad's in the back and prepping stuff. Alternatively, maybe they're a 50-store operator, but you could see everything in between. I remember, Quiznos subs, right? That was hot and heavy 20 years ago. They were everywhere, and they're gone now, essentially.
Is there any left?
I'm sure there's some in an airport somewhere.
I used to eat there all the time.
Yeah, they were great.
They're huge.
They like brought out the toasted sub that now you see everywhere. But
it's like game changer.
Game changer. Yeah, but those were all franchise, and a lot of them were 1 and 2 store operators. Like that was it. But that was a great way for somebody to kind of own your own company and what have you. Well, it's hard to keep the quality at that scale on 1 to 2 store operators, and that. Qdoba, maybe that's their first location and they're trying to figure it out. But it's apples and oranges when you compare that to a corporate Chipotle. You just can't get the same consistency.
Yeah, and from a cap rate perspective, it's minimum 50 basis points and probably well above that at this point. I bet it's 100 basis points of difference between a corporate and a franchisee. You got to really dig into the franchisee. What do their financials look like? How many locations? How long have they been operating? Because it all comes back to risk. Like, what's the risk to this buyer?
Yeah.
And that yield has got to be at a point where it makes sense for the risk that they feel like they're taking on. And franchisee credit's just not as strong. And what's interesting, kind of related to that, is how many corporate guys are coming into markets. And then you got to really, as you guys invest in new deals, you really want to look at, do they have assignment rights to their franchisees? Because most of them want to include rights to franchise to assign to their franchisees, where they'll come in and open a market corporately. They want to have the ability to sell it off to a franchisee, and you got to really look at that language because it can change the deal completely. Where I thought I had a corporate entity that maybe is worth a couple $100 million or maybe more than that. Now all of a sudden they're signing it to a franchisee that has a net worth requirement of maybe $5 million, that credit profile is drastically different.
Yeah.
And that's more than 100 basis points. So you got to really look at that stuff.
Interesting.
Yeah.
And by the way, even if they haven't assigned that lease, just having that in the lease is a problem when you go to sell it.
That's right.
Right? It's like, hey, we can see what's coming on the horizon. So you're going to get dinged right out of the gate as if it's almost already happened.
Well, it's like, it's a perceived risk, right? It's like I have an iOS site right now I'm listing, and it has a dart rail spur in the middle of it that's bisecting the property, and they own this sliver right in the middle.
Mm-hmm.
Dart's never putting a rail there, like ever. Like it makes zero sense, but everybody's like, but it's there.
Right.
You have a license agreement and go back and forth, but the license agreement says, hey, we can take this back in 30 days notice.
Right.
Like, so everybody's, it totally, it's devalues the property tremendously from what it should trade at.
Right.
So maybe to the tune of, you're talking about going from mid 3 millions to south of 3 type deal,
Wow.
that could significantly impact the price.
Yeah.
So the same thing, it's, if there's that hook in there, they're gonna ding you for it. So
right.
Interesting. So just even the positioning then you're saying of the physical improvements could make it a challenge, because it's a challenge to lease. You'll end up getting franchisee credit instead of corporate, just because of the positioning of the building or maybe the access. And
so most of the time, and not always, but you've got markets are identified as corporate or franchise going into it. So they would say, for instance, everything west of 35 is franchise, everything east is corporate, and then those groups aren't stepping on each other's toes. Now, that's not always, but most of the time you've got a clear and defined kind of trade area of this is either franchise or corporate. Now, the real estate itself, typically franchisees are going to accept real estate that maybe corporate wouldn't. Corporate traditionally is willing to pay more rent because they want better spaces, and they're viewing it differently than a franchisee who's trying to minimize their risk and keep their rent low, that is maybe going to take an inferior location to get into a good market that they hope is going to perform.
So does that ever work out though? Like it's kind of like you pay for good talent
Totally.
type situation. Like the franchisee is trying to save a buck on rent, but at the end of the day, had he taken that location that a corporate tenant is like, I'm not doing that. I'm only doing this location. Had the franchisee taken that location, do they end up winning? Most likely in the end, is there, I mean, as a tenant rep, right? You got to probably sometimes, when you're negotiating for these guys, like how do you ever try to push them out of their budget, like in comfort zone, to be like, hey, we can go down here, Qdoba, or you can go over here to Chipotle where there's a line around the corner all day long. Like,
But think about it. Even if they had that Chipotle site, right? Let's just trade sites. You still didn't have a great experience there.
Yeah.
The food was mediocre at best.
Yeah.
So at the end of the day, it's about the product and the service that you're getting in there. Even if they have the best site in the world, if those things aren't ironed out, it's still not going to work. So, for smaller companies or for franchise, sometimes it's, hey, we got to iron out some details here. We got to make sure we have our operations in line and prove the market up. And then, maybe we do look at relocating in 5 years. Let's only sign a 5-year lease here and give ourselves some options in the future. So there's something to be said about that. But it's not always, even as real estate guys, not always about the real estate. It's also about how you're performing there. And I think alternatively, Chipotle's such a driver of traffic. They probably could have been in that Qdoba site and would still be doing decent numbers there.
Okay.
They're going to be doing better out on the hard corner with a Chipotle, for instance. But, at the end of the day, they're still going to perform in that market. So sometimes, hey, would you rather an A+ site in a B market or a B site in an A+ market? How does that work? What is your forecasting change in that model?
So I guess on the Chipotle side of things, I don't know, we talk about Chipotle all the time.
We didn't know we were going down this rabbit hole.
Well, we eat there all the time. And then we've done 2 or 3. We've participated in 2 or 3 of them. And when they came in for us to do, we were like, oh yeah, like we know this product. Yes, beef. So, but the quality of the product is really good.
Yeah.
And I don't know. It's just they trade well.
Well, I guess so. If Chipotle knows they can go into a market like that and they can go into an A+ site in an A+ market, is that negotiating power to the landlord to be like, hey, I'm going to, especially like in a triplex, like, hey, look, I know rent's $50,
Right.
but guess what, bro? I'm going to bring in like 400 people a day running through here for your other tenants.
So that brings up a whole nother point, right? Let's talk about, Dallas, Fort Worth in its current market conditions today.
Mm-hmm.
We're at the lowest vacancy we've ever had in history. And, there's new product coming out of the ground that's being built today. But what we're going to see is a gap in inventory, right? So everything that is being delivered now or soon to be delivered, that all started 24 months ago or 18 months ago, 12 months ago. What we haven't seen is stuff having been started in the last 6 or 8 months.
Yeah.
So you're going to see a huge gap in deliveries that's on the horizon. And all of a sudden you've got low vacancies, increasing rents, and no new deliverables coming online after this kind of batch is done. What happens then? That $50 end cap, to your point, now becomes a $60 end cap because you've got a ton of tenants that are chasing the same space.
Yeah.
Chipotle just becomes one of 6 offers that you received for that same end cap opportunity, especially if you have a drive-through. Now maybe you have 8 or 10 offers for that space, and you can kind of take your pick of the litter. Now, maybe as a landlord, you decide you want, quality over quantity, right? Hey, I want a fair, aggressive rent, but it's really about finding that right tenant to add value to my center. Alternatively, you got some, landlords that are going to try to get the most rent they possibly can, and they're going to sell it in 6 months, and it's going to be somebody else's problem down the road. So there becomes a balance there. And, as a tenant rep, you're thinking, what's a healthy rent figure here that my tenant can live with and be successful, right? Even if we agree to pay that number, if our numbers are not in line, all of us have a problem that we're going to have to solve for in 24 months. So how do you, how high is too high? So there's a delicate balance there of all of those things to, figure out the right co-tenancy that works for everybody at the right rental rates.
Well, to that point then, Bob, on the back end, right, if someone tries to come in and negotiate, or let's say market's not as hot as it is, right? And, big 800-pound gorilla tenant walks in and beats the landlord up significantly, then you're devaluing the building on the exit, right? Just based on income, right?
Yeah, for sure. I mean, it's all based on income. I think where a lot of it will come down with clients right now is they'll be evaluating, to Rob's point, there's demand from multiple tenants. And then, they're always trying to, especially with construction costs and everything so expensive right now, it's like, how do I get to a rent where numbers make sense? And then it becomes, all right, hey, I've got McDonald's in there at X and I've got Chipotle in there at Y, and they may be different. And that's okay. If they're ultimately going to sell, they may know that, all right, Chipotle's aggressively maybe are trading in the 4.5 cap range and McDonald's are at a 4. So they're taking that into account when they're looking at, hey, maybe, McDonald's at 120 is better than Chipotle at 130 because the cap rate difference. So they're evaluating it that way. And then I think, when things weren't as aggressive, to your point earlier about demand from, whether it's a Chipotle or Starbucks, I think they were using that as leverage with landlords when it wasn't as, competitive as it is right now. Hey, we're going to bring additional traffic. And those were attractive to landlords that were building multi-tenant properties and they had Chipotle or Starbucks or somebody like that on an end cap because they know, hey, these guys are going to generate, traffic for the center. And it does help them recruit. If they've got a 8,000 square foot strip and they put them on an end cap, they know it's going to make it easier to fill the rest of it because those guys are going to generate traffic for the center. And ultimately, that helps because of their credit and everything else. It's going to help them on the exit if they go to sell it.
Yeah. And then I guess it helps you hold rate with your new tenants coming in, the UPS store, the Sherwin-Williams or whoever. It's like, hey, I can drop my first class, whatever, overnight. I got to send and go grab a latte type thing. So I guess it's the synergy of the tenancy there.
Right.
So you said that we had a gap. We're going to have a gap in deliveries.
Right.
Why did they stop developing?
Interest rates.
Interest rate?
Yeah, construction costs and interest rates, right? It's a double whammy where, essentially pricing just got too far out of line. You know, as a developer, you may own a piece of property and you're sitting there going, hey, if we build what we would have built 24 months ago, you know, our rents would have gone from 38 to 58, right? Like at some point in time, you're worried, hey, can I even lease this property at the rates that I'm going to need to get the return that I want? So it was really the double whammy of both of those things going up simultaneously very quickly. And I think ultimately as interest rates come down and you've seen construction costs stabilize, I think that gets better over time, but we're not there yet.
Yeah.
When in the backside of that too, in addition to, you know, interest rates and construction costs, for so long, people could look up at the end of it and sell it and feel comfortable. They were going to make money. And I think interest rates being low for so long, for the last 10 plus years, construction costs have gone up after COVID like crazy. So that was different. But even over the 10 years prior, construction costs would go up or developments would have an extra $50,000 because I didn't realize I got to bore under this street to go pull utilities. And then developers would still be okay because cap rates were low and they continued to stay low and compressed. And so that cap rate compression over the last 10 years has continued to help developers still make sense of projects. And so now with what Rob's saying, and then also you've got cap rates bumping up because, you know, everything that's going on in the market, it's just, you've had developers pull back and go, hey, I got to reevaluate. Things don't make sense right now.
Well, I think that goes back to the efficiency of ICSC, right? Because then you're sitting there, you know, saying, hey.
Was this Vegas?
No, this was Texas.
Yeah. Okay.
Hey, it's coming up, by the way.
I know.
We got to get our tickets.
We're going to get you guys a booth this year. We'll put you.
We're out of money. So
that's a waste of your dollars. Go for it.
If we can land some of these things people we're talking to, then we'll get a booth.
Yeah.
But no, you know, but that comes back to the efficiency of it, right? You're like, you're saying, you're here in the middle telling this real estate director, look, dude, you got to let him build to an 8.5 now. Cause like,
totally,
he's got to have compression. Otherwise, why does he do it? You know?
Right.
And so that's what I thought was so cool about the efficiency of that market. So everybody kind of knows what everybody's making, which creates an efficient market, right? We make a lot of money in arbitrage in the industrial side through an inefficient market.
Right. Yeah.
But the scalability of this is so much larger because of the amount of transaction volumes that have to go off.
And I think that used to be the same case in retail.
Mm-hmm.
And then retailers now are just a lot smarter. You know, information's much more available.
Right.
Tenants know where they're, you know, they have an idea or pretty solid range of their cap rate that they're trading at. And what's interesting is they always go point at the most aggressive ones, which are usually the outliers.
Sure.
And, hey, I want you to develop there. And so they've kind of crammed down all their developer clients. And so the developers, you know, for so long they want to do right by the tenant. It's you know, definitely a partnership type of arrangement, or at least they try to position it that way, that's how they grow. And that's how the developer does more deals. And it's about volume, not just onesie, twosie types of deals. And so it becomes more efficient. They know what they're doing. They can deliver on time. Those tenants get sales weeks, which is important to them. And then they have a good idea where it's going to trade. And then all that's been, you know, kind of out the window the last 12 months or so. Tenants started really pushing back on developers because we went through this period of time in 2001, beginning of first half of 22, when cap rates compressed so much just because of lack of product and a lot of buyers in the market, a lot of private exchange buyers in the market. And then so they're getting, a lot of the tenants have ROFRs where they're seeing what these things are trading for. And then at that time when things got so aggressive, they started really driving down development yields and where they allowed their developers to build to. And it was really the worst time because they hammered them and pushed them down, crammed them down right as interest rates were ticking up. And so it's taken probably 12 months for developers to really continue pushing back on their tenant clients before those guys have started to ease and adjust the build caps, adjust rents to where it's getting more in line with where the market is today.
Yeah. No,
I feel fortunate that we started our business when we did, because we've heard of stories of guys capitalized deals with tenants and developers where they started in 21, locked everything in, or early 22, and then interest rates spiked, cap rates slid,
construction
costs went up. Everything just moved dramatically. Not like, we had a $50,000 hickey here or whatever. Cap rates bumped 25 bips and we'll get through it. It was like, no, pretty sizable movements. And so we have a clean balance sheet, so to speak. We've got no damage from before. So we've been able to kind of move quickly, not have any battle scars. So,
well, I guess, what was it? Now you've got some of the big box guys are going out here lately. You've kind of had a slew of them lately. What's your take on that?
Disruption is good for the industry, right? There are very few centers that are going to absolutely suffer because they lost big lots, for instance. Now, that's easy for me to say. I don't own one, but in general, there's, when you start talking about the lowest vacancy in the history of Dallas, well, we need spaces to come on the market. And I think, what we're seeing, whether it's American Freight going bankrupt or Big Lots going bankrupt or Red Lobster or TGI Fridays, disruption is good, right? That clears up some of those, whether they're pad opportunities for redevelopment or anchor spaces that can be repositioned. That's, honestly, that's kind of what we need. That's what keeps the market fresh. So, for us, it's negative headlines that people read and think, the death of retail has been over-exaggerated for the last 30 years. And I don't think that's ever going to change. But it's, whether it's Bed Bath & Beyond and Bye Bye Baby filing for bankruptcy, some time ago, you look around Dallas now, there's maybe one or two spaces left of those boxes. The rest have been leased.
To pickleball?
Pickleball is taking quite a few of them. Whether it's fitness concepts or, Burlington or, other tenants.
TJ Maxx and some of those value retailers, Ross, those guys are still active and trying to do new deals. So I think they welcome some of that bankruptcy and vacancy because it gives them opportunity.
Yeah,
well, maybe the landlord does too because they were locked 100%. Into a longer term lease at a lot lower rate.
They're raising the rates too.
So that's why you see a lot of those groups go through the sale process afterwards, auctioning off their sites because they've got, they might have 4 or 5 year options at stated rent with 3 years left on the existing term, and they're all super below market. I think Burlington bought 18 of the dark boxes. So it's one of those.
They went out directly and bought them.
Oh, so this is a crazy ass concept right here. So
totally
back up and explain what you're talking about because this is wild to me.
Yeah. So when a company goes bankrupt, they can take their real estate out to bid, right? Because they essentially
and you're talking about their leases.
Their leases. Yeah. Sorry, I'm going to be clear. Yeah, they're leased properties. They have that under control for the next 25 years. Okay. A lot of times these anchor spaces are single digit rents. They're currently paying $650.
Triple net.
That's right. Yeah.
Whoa.
So, they've got 3 years left on the term with 4 or 5 year options. Let's say market is now $16 or $18. And alternatively, you're a Burlington who's growing like crazy. And not only do they want to get a value on the real estate, but they also want to get in front of it and make sure it doesn't hit the open market. Because the landlord may go, I don't want Burlington. I want TJ Maxx instead or whatever it may be. As a tenant, you could control your own destiny and go out and bid for those boxes. I think Burlington paid $18 million plus or minus. Maybe it was a bigger number than that.
Just straight cash.
Straight cash to assume those leases. And those anchor tenants have assignment provisions that basically landlords can't push back, right? You've got another credit tenant coming in to take the space.
Their credit sucks now anyway, so the credit's better.
The credit's better. So you're bidding to assume that lease and now take over and pay the rent that they were paying. So that's something that wasn't really in our business, 5 years ago, that is now common practice for those companies that are going to be.
The landlord hates it.
Hates it. And by the way, as a landlord, your hands are tied while it's in bankruptcy court because all of that $18 million is going to pay back creditors from that company that went BK. So it's a win really for everybody but the landlord, in all honesty. Yeah. Everybody else wins. We got money coming in. We got a new tenant coming in who's getting a great space at a great value. We're getting the other tenant off. Except the landlord is stuck and doesn't know if they're going to get their space back or not. So they're getting calls.
Who's coming in? Who's paying that number?
Sure.
They're
getting calls from prospective tenants. Hey, I love that Big Lots box. I want it. Well, I can't lease it to you until we've cleared the bankruptcy court and made sure that lease is not going to be assumed by somebody else.
So, but how does the tenant keep those rights if they're in bankruptcy, they have probably committed an act of default at that point?
Well, nowadays I feel like they've gotten so much smarter. They're not, right? Keep paying your rent on time. Keep doing all the right things because your lease now has value to it. And again, that was a different way of thinking 5 or 10 years ago. But now, if you've got a tenant going into BK, most of them would stop paying rent immediately, right? If you knew you were going to file at the end of the month, you're not going to pay that month's rent. That's not the case anymore. Now you're going, our fleet of stores actually have value to them. We need to keep things going so we don't go into a default position. And they can actually market those.
And we'll pull that plug on this date. Just pay rent until then.
Pay rent. Actually, keep paying rent.
Keep current. They've got to keep paying rent while they're in bankruptcy.
That's right.
Yeah.
So do you think that might have happened? You remember, was it probably about 5 years ago when they changed the accounting rules where you had to list leases as liabilities on your balance sheet? Now you offset it with a asset of right to use, but
sure.
Do you think they're they're tracking rents and going, hey, we've got a disparity here where our rentable value of our real estate that we have the right to use on versus the liability of what we own on it has a $18 million gap in it. We can go sell this. We're probably better. Do you think maybe that had any correlation with it? Because it's about 5 years ago when that happened. I don't know if y'all remember all that.
Yeah, I don't really know, to be honest with you.
It was just an accounting rule. It's not just retail, but it was an accounting rule that the IRS came out with, and they made you list leases as liabilities.
So I think there's a court, companies would come in and help a bankrupt company liquidate their stores, right? You guys have been in one of those stores that's going out of business.
Well, we've had tenants who've gone BK. And we've had to deal with the court of trustees that get them out.
So, but think about it in a retail standpoint. If when Bed Bath & Beyond closed, they 50% off everything in the store, and then it goes to 60, and then 70 and 80, and then they get to the point they're selling the fixtures, they're selling the cash registers and the security cameras. Even if it's bolted down, they'll still sell it, right? So, I think ultimately those groups came in and said, well, what else has value in this company? And that may even be an industrial lease. Lumber Liquidators, right? That's a company that went BK. Well, they've got some pretty good stores, a lot of which are in industrial centers. They did a big distribution center in Fort Worth. Maybe they're super below market. I don't know the answer to that, but you go,
they just did 500 and then BK a year later.
The guy who sells us buildings tenant them into it. And then my next door neighbor is the asset manager. And they were just dogging each other. I was like, they put two and two together. And I know both of them very well, and they were both just like, you got. I was like, I don't want to hear about this. It sucks.
But, ultimately, maybe they're paying low single digits, and there's no other vacancies of 500,000 square feet in that market. There's value in that, right? It's the same thing.
Yeah.
How can we squeeze as much money out of this company as possible? And I think ultimately that just led to the leases having value in it as well. And how do we monetize that?
Well,
I was just going to say there's super smart attorneys too that are, some of those leases are landlord friendly and some of them are tenant friendly. And a lot of these where they're assigning them obviously are tenant friendly. I think there's some landlord friendly leases where they don't have as strong of assignment rights where if they do file BK or something that they can potentially lose it and not just be able to freely assign it. Unless it's somebody that comes in and takes over the whole company.
Yeah.
Not in, hey, we're going to assign these 5 leases or these 10 leases. They can't package them up like that.
Yeah. We kind of have a saying around here that landlords need more representation than tenants do most of the time because even on the leases we get on an industrial side, we're like, are you an idiot? Why did you sign up for this?
We've got 2 in the hopper right now. You're like, who represented you? This is awful.
Yeah.
Like we cut your lease, cut the building value in half.
Yeah.
It's unfinanceable. It's incredible.
Sometimes you just need a good attorney, right, Rob?
Yeah.
We talked about that earlier.
We talked about that earlier. Yeah, we had a smaller tenant that we were just trying to help out, and we were on a call with their business attorney who's trying to act as a real estate attorney. He's like, yeah, we just have to change this one provision and the lease is ready to sign. I said, you're not going to make any changes at all? And he said, no. I said, respectfully, sir, I've done this for a long time. Never has that happened to me, nor do I recommend this. And I'm like, I need my client to leave your office and have him call me, please. And I'm like, we need to fire that attorney immediately.
Yeah.
And we did. We now engaged a real estate attorney, and he's reviewing the lease as we speak. But it's amazing.
You told him to stay in his lane.
Hey, look, it's amazing what some people sign off on.
Yeah.
We've greatly benefited from it, and then greatly shown people how much money they lost, millions of dollars.
Yeah. Hey, we'll call you in 10 years when this is fixable. You know?
We've also been unbelievable beneficiaries of it too.
Yeah.
Because of the arbitrage in the industrial business.
Yeah.
Sure.
So. We've seen it with, smart guys too that are maybe developers. They're just trying to get in, but tenants, when things weren't great for developers, Starbucks is putting termination rights on a brand new site, build-to-suit, where we know they're doing 10 years all day long, and they'll put a termination right in it after year 5 or after year 7.
Scary.
We're like, why would you do that? How do you? That's not sellable with the other product that's on the market that's normal.
Yeah.
So it puts you in a tough spot.
That sucks.
Yeah. Well, it's like, do you remember the lumber deal we looked at in Oklahoma City? We looked at a deal. I loved it. I wanted to buy this building so bad.
Yeah,
but what they did is they did a true gross lease, no modified,
right,
full, no pass-throughs whatsoever.
Yeah.
They signed fixed renewals for the next 20 years. And on that side of things, I think the building was on the tax rolls at like $1 million.
Right.
And we were willing to pay around like $9 million for the site. Well, Oklahoma is a disclosure state.
Full disclosure state.
So we're fixing to eat that tax bill. And I'm like, this attorney's the one that signed the deal. And I'm like, this attorney just, you should sue him.
You can't even buy it.
You can't.
Right. The tax bump just eviscerates all of. I think we kind of forecasted it. I think the tax bump was more than what the actual rent was.
Yeah.
It was like, that doesn't make sense.
Yeah.
Throw in insurance too, and it's crazy.
Yeah, it's nuts.
Yeah, you can own this. How's that sound?
Yeah.
Well, okay. I want to talk about just real quick how we're going to kind of format this going in the future. Our thoughts are to cover kind of a group of tenants, and we'll kind of cycle some new ones in and out of there. Obviously, we're going to track Chipotle.
We're going to change the name of the podcast.
Thank you, Chipotle. Show how completely opposite they are.
Yeah, actually not bad.
But seriously, right? That's what, we're going to get Chipotle to sponsor this. And I don't know. Why don't y'all just kind of touch on kind of some of the format of it that we've talked about. I'd like y'all to speak about it because y'all are more in tune with those things. But.
Sure. From a tenant perspective, we'll cover probably 4 or 5 that we'll kind of just continue to monitor. What's it look like as far as what's on market? What's happening cap rate trend wise? Is it trending up, trending down? Does it have anything to do with the supply that's on the market or anything that's going on with them publicly that may be affecting it? And then we'll try to monitor that just so people as they listen in can kind of get a gauge for, what's going on in the market, trends and so forth, and cover potentially, a handful of those tenants. Maybe we spotlight one each podcast so we can kind of dive in a little bit deeper on it. And, I think it'll give the listeners a good kind of flavor for what's going on in the market and what's happening in retail.
Yeah.
And then I think we're also going to focus on kind of headlines once a month, right? What are we seeing in the marketplace? Who's growing? Who's struggling? What's the latest? That's the Michelin is all the, rave right now. That's something we'll focus on going forward is what's new in the marketplace, not only in Dallas, but what are we seeing around the Southwest and Southeast? And then we'll also, highlight those tenants that that I think really have a change in dynamics one way or the other. And how do we see that playing out over the long term?
Yeah. I think something that's definitely come out of today is we also need to talk about lease points that affect lease terms that affect value at the end.
Yeah.
So,
I mean, a very good example of that, I think, is you just look at Starbucks today. Great. I love the brand. I've worked there. They're doing really well. I know they're retooling a little bit. They brought Chipotle's CEO in to try to get them back on track as far as, positive comp store sales, which they've been down. But overall, good brand, good product. They're trying to continue to grow their lease structure from an investor standpoint. A lot of investors just don't like. It's a shorter term, 10-year primary term for the most part. They'll do a little bit more than that sometimes, but then landlord has responsibilities. So when I look at them and Chipotle, both very good brands, similar types of real estate, both doing drive-throughs, both going freestanding, both will do end caps that are prominent. So a lot of similarities as far as real estate and kind of the target market. You'll even see them do buildings together, and I think they perform well. But I would tell you that Chipotle's lease to an investor, which we're primarily dealing with private 1031 investors or private client type investors, and their preference is always Chipotle right now. And it has more to do with the lease structure, whereas Chipotle will do a 15 or 20-year term.
Wow.
And they'll do true triple net where they're paying all the triple net charges, and Starbucks won't. And there's this we call it double net. I mean, they're reimbursing for everything, but the landlord has responsibilities and they're primarily just doing 10-year terms. Those cap rates should trade very similar in my mind. I've even talked to some at Starbucks that I've got relationships with, and just like, guys, y'all should change it. It would be better for y'all long term. It'll reduce your rent. It would really open them up for more investors to come buy that product, whereas that investor will gravitate to Chipotle or others like it over Starbucks, and I think they're very comparable.
And that's being signaled by how many are on the market.
Absolutely.
Yeah.
So that'll be another thing is how many are actually on the market, So, well, man, is there anything else we want to touch on today, or what do you got, Rob?
Well, I said
Florida
that to you
Gators.
guys. Yeah, the Gators. Come on. The Gators beat LSU this weekend. I feel good about myself.
This is a good win.
We're back. So, I sent you guys the Michelin Awards. I thought that was very interesting. So, I don't know, quick backstory. So, the state of Texas essentially pooled $900,000 to contribute to kind of kick this off.
Correct.
And I think it was, it appears to be money well spent, right? The press that has been generated off of this is significant. There were, 123 recognitions across the state. I thought it was interesting, of the 1 stars that were given, there were 7 in Houston, 6 in Austin, 1 in San Antonio, and only 1 in Dallas. So I kind of felt like we were a little bit of the stepchild out of the gates. But of the recommended, kind of the same thing. So you had 23 in Houston, 20 in Austin, 7 in San Antonio, 7 in Dallas. But they were talking about how the uptick for those guys, anybody that's on the list, even as a recommended group, they're showing 18 to 20%, sometimes larger than that, increase in sales once you're on that list. I think it's interesting. And it's one of those things that gets better with time. Right, they had some missteps. They had the wrong restaurants listed that they've come out and fixed. One of the groups had just closed 2 days before the announcement.
Oh, really?
Oh, yeah. And so then they get it added to the recognized list, and it was like, well, wait a second. How do we open back up? Because all of a sudden their phone starts ringing.
Yeah,
demand is off the hook.
Yeah.
So, anyways, it's interesting, but I think it's one of those that this will come out every year with new restaurants on there, and hopefully we see some 2 stars and maybe eventually some 3 stars added to it. But it's look, I think at the end of the day, it's great for Texas. It's great for restaurateurs. It's great for landlords. It's a win all the way around, and I think we're only at the the start of that. So it'd be interesting to see how this thing progresses over time.
It is interesting. I didn't know the backstory on Texas investing in it, but I was like, I didn't even know barbecue joints could get on here.
Oh yeah.
Oh yeah.
So I was like, I want to go check out Panther. I saw in Fort Worth. I'm like,
it's great. I've been there before. It's unbelievable. Really? Oh yeah.
So there were actually 4 that received 1-star reviews. In the history of Michelin, they have never recognized a barbecue restaurant. And now, as a state, we got 4 on the list as 1 stars, and that was pretty neat. And a ton of the recommended restaurants were barbecue places, and it is kind of neat that they included those in addition to obviously the fine dining and everything else. The other thing, Michelin is the actual tire company.
Yeah.
Yes.
They started this to get people to drive further to go to restaurants to buy more tires.
Yeah. Did you not?
That's so serious.
I did not know that.
Yes.
That's what started this entire thing. Was somebody at Michelin was like, hey, if we give reviews on restaurants, people will go out of their way to visit those and in turn put more miles on their tires and buy new tires.
Yeah.
Wow.
And it was like, now that's a reach, but I love it. That's fantastic.
great.
Why did they wait so long to do it in Texas, considering it takes forever to drive anywhere in Texas?
They need to review the restaurants in El Paso. Get us all headed up there.
Yeah. I don't know the legit. I've been kind of tracking it for a while.
Yeah.
I don't. There is some, I think, just politics in the restaurant world that kind of prohibited it. So
they only allow it in the Northeast.
There's a little bit of there's a little bit of a pay to play in that space, and so like Rob highlighted, like they coughed up almost $1 million to like get them in. It's a big to do.
Right.
It's mostly focused in Europe and on the coast, and so in Asia.
So when you go to Europe or Mexico City, for that matter, you've got 3-star Michelin restaurants that people are traveling in from all around the world to go dine at. I think you could fly to Mexico City and eat at 5 3-star Michelin restaurants, and people do that. Like that's your trip. And so again, we're at the starting point of that. It's going to take us a while to get there, but I really believe that kind of food tourism is real. There's no doubt that this is a great thing for all of us.
There's a place in Rome I've been trying to get to this week. I'm leaving on Wednesday. I've been emailing back and forth with the hostess for months.
Are you going to eat by yourself?
No, yeah. No, I'm not going to be able to get
He's
in.
going to Rome by himself.
By myself. It's just the timing of all of it with my wife.
You guys investing in a deal over there?
I wish. I will one day. But no, just to that point, it's just, I can't get in.
Yeah.
It's just,
Tell me with Michelin.
Exactly. But it's just timing on all of it. Yeah. And you think it's just one body. I'm like, hey, I'll eat in the corner. I don't care. But and then we had another time when we were there on our honeymoon. I called American Express. I was like, hey, I want to eat at this place. I haven't been able to get in. And they somehow were able to wiggle me in. I got a phone call back like that from my platinum card. And they're like, we've got a spot. And like, boom, it's been one of the highlights of our eating out experiences.
I love
it. But if any other states question it anymore, we dominate barbecue, apparently.
100%. Yeah.
The place you got to go to is Goldie's, that place down in Arlington. I haven't been.
So what are the 4 barbecue restaurants on there?
You're going to test me on that. That is not on my list. Hang on. I'll get there.
I know Goldie's made the A-list.
Panther was on.
Yeah.
Where's Panthers in Fort Worth?
Fort Worth.
Correct.
Where at?
Panther Island.
Oh, it's on Panther
I don't think so. I think it's on the south side of downtown.
Okay.
Just west of 35.
You're probably right. I'm probably wrong.
Just because I looked it up.
I ate there 2 years ago. It was really good. Yeah. It's really good.
So the 4 that actually earned a star versus the recommended list. So we had quite a few in Dallas that were on the recommended list, which is still an amazing accomplishment.
Yeah.
The 4 that got a star were in Austin and Houston. And they, unfortunately, we didn't have any in Dallas.
I thought Panther got one, or they just got
recommended list,
okay.
Which again is a great accomplishment. But to actually get a star is amazing. So to have 4 in Texas, none in Dallas.
Do you get to reapply? Like I up my barbecue game, come back.
So that's the thing. You don't actually apply. They seek you out.
Okay.
Right. They go undercover and go to these different dining establishments and dine, and then you get a review, and all of that's compiled internally. And fast forward, they sell more tires, but somewhere in between. But there's no application process. But those, obviously, it's a it's a ranking that you're on the recommended list. They're going to try you again next year. Maybe you work your way up to a 1-star because you ultimately upgraded your quality or your service or whatever it may be. And the 1-stars are now eligible to go to 2 stars. So all of those folks are trying to work their way up the list.
Okay, so you do get another shot. You just
Every
don't.
year.
You
They're
just, every
constantly,
year.
they're just, it's like food reviews. You have no idea who's in your restaurant that
That's
night.
right.
So you better perform.
Yeah.
What a job. Like, what if that's your job? You're like the Michelin
I know
guy.
somebody who does, and they just fly undercover, dude. You have no idea. They just fly around, or they're in their city, and they just
Maybe that person could book a reservation for you in Rome.
Nah, I don't have that kind of pool. Yeah, but no, it's incredible.
Yeah.
What's that book? There's a book I've been reading. It's 111 Park Madison or whatever. It's about like hospitality. The guy wrote it. Houston recommended it.
It's fantastic.
Yeah, it is. And he tells like the heartburn and the angst about trying to get their Michelin stars.
Unreasonable hospitality.
Unreasonable hospitality.
It's a great book.
Unbelievable book. Yeah.
But the point is, being on point literally every single night because you don't know who's going to walk in there.
You have no idea.
Their goal was to get a Michelin star, which ultimately they did. Mm-hmm. And it was every single, then they're scrambling around because they think this guy might be the Michelin reviewer. And turns out he was.
Yeah.
And he dined there like 4 times before they ultimately gave him the 1 star.
Yeah.
But it was the pursuit to get there and all the unreasonable hospitality that you need to provide to your customers to really be able to achieve that level of success. It's a great book.
I mean, that restaurant's like, we're so good, we sell tires.
Taxi drivers.
That's right.
I always think Tom Link should be a Michelin food taster. Could you imagine him in there?
No, it would be terrible because he would just tell everybody, I'm here for Michelin. I'll literally order everything.
With 8 cups around him. Right?
Yes.
Right.
Yes.
So, well, cool. I think let's bring this home. So again, we're going to do this monthly. We're going to kind of get in more of a format. Today was kind of just a, fire away, but, I'm excited about doing this with you guys. I feel like I've already learned so much more just today.
Yeah.
So, is there anything else you guys want to add before we wrap this up today?
I don't think so. Looking forward to it and appreciate the opportunity to hang out with you guys and talk shop.
Yeah.
It's going to be fun.
Of course.
Yeah, absolutely.
We appreciate it.
Well, see you next time.
Let's go. Let's go.